Welcome to the finish line, everyone. If you've been following along with us through the previous sections, huge congratulations. You've really done the hard work. You've mastered the math, you've nailed those complex journal entries, and you thoroughly understand the mechanics of capitalizing contract costs. But, well, all of that incredible work doesn't mean much if the whole thing falls apart at month end, right? Now it's time to actually report, defend, and govern those numbers. So in this final explainer, we're going to lock in your knowledge by looking at the entire operational lifecycle. Okay, let's dive into this. Here is our operational roadmap for today. We'll be moving through financial statement presentation, required disclosures, common mistakes, passing the audit, and finally, controls and close operations.
Let's kick things off with Section 1, Financial Statement Presentation. This is all about mapping those costs directly across your financial statements.
To properly map these costs, we have to know exactly where they live. And on the balance sheet, we are strictly bound by the 12-month rule. Basically, any portion of your asset that you expect to amortize within 12 months of the balance sheet date, that's a current asset. Anything that's expected to benefit a period beyond 12 months is non-current. Pretty straightforward, right? Then, as those assets actually amortize, they hit the income statement. And notice how they're classified based entirely on the nature of the cost. So costs to obtain typically drop right into SG&A, or sales and marketing. Cost to fulfill, on the other hand, well, they align with where the related revenue is recognized, so think cost of revenue or cost of services. And finally, your cash flow statement handles the initial cash paid as an investing outflow, while the ongoing amortization acts as a non-cash add-back in your operating activities.
Now let's see how this builds into one of the absolute most critical distinctions in revenue accounting. ASC 44020 contract cost assets are entirely different from ASC 606 contract assets. Teams constantly mix these up, mostly because they both literally have the word contract in the name. But here is the reality. Contract cost assets are prepaid costs. You've already spent the money to get or fulfill the contract. Contract assets under ASC 606, though, are conditional rights to future consideration. That means you've done the work, but you just haven't billed for it yet. Confusing a prepaid cost with a conditional right to revenue is a big deal. It will result in a severely misstated balance sheet. Bottom line, they must never be combined.
Moving right along to Section 2, Required ASC 340-40 Disclosures. This is where we start telling the real story behind those numbers.
You see, the numbers on your statements are really just the summary. The disclosures are what actually enable the users of your financial statements to understand the nature, timing, and financial effects of these capitalized costs. There are 4 main required disclosures you absolutely have to include in your notes. First, your accounting policy for cost to obtain. You must explicitly state here if you're electing any practical expedients, what exact types of costs you capitalize, and exactly how you determine your benefit periods. Second is your policy for costs to fulfill. Third, the quantitative disclosures. This means providing closing balances disaggregated by type, so separating your obtaining costs from your fulfilling costs. And lastly, if things go off the rails, your impairment disclosures. You've got to lay out the specific judgments and facts that support any impairment conclusions you had to make during the period. Which brings us to Section 3, Common Mistakes to Avoid, Navigating the Pitfalls of ASC 340-40. Now, what's really interesting about this area of the standard is just how easily teams can trip up. Knowing the rules is one thing, but applying them consistently, month after month, that is where things get tricky. I want you to think for a second about the entire capitalization lifecycle we've covered together, from identification to measurement to amortization. Where do you think the weakest links are? Where do teams usually go wrong?
Well, if you take away just one absolute non-negotiable rule from this entire explainer, please make it this: bid costs are always expensed. No exceptions. The absolute most common error teams make is capitalizing non-incremental costs, things like proposal drafting or travel expenses for a sales pitch. Remember the golden rule here. If the cost would have been incurred even if the contract was ultimately lost, it is not incremental. It completely fails the test. You have to expense it immediately.
Let's look at the cause and effect of a few other major mistakes. A really big one is defaulting to the stated contract term instead of the true benefit period, completely ignoring any expected renewals. Or how about applying the practical expedients selectively, just based on convenience? Remember, it's an accounting policy, not a choice you get to make deal by deal. And then there's ignored impairment. Imagine a scenario where you have a struggling customer. They've stopped paying, they're downsizing, but their capitalized commission asset is just sitting there on your balance sheet, totally untested, slowly amortizing as if everything is perfectly fine. That is a massive red flag. You must build impairment controls into your close process, and especially make sure you're writing off canceled contracts immediately.
And that flows perfectly into Section 4, passing the audit and what auditors actually expect to see from you.
Because here's the hard truth. Correctly calculating the math in your spreadsheets won't matter at all if you can't defend the asset with proper documentation when the auditors come knocking. This is the exact evidence they are going to demand. They don't just want to see your math, they want the source truth. To prove a cost is incremental, they're going to want to see the actual commission plans tied strictly to signed contracts, not just broad-based salary allocations. To justify your amortization timeline, they want to see your historic churn rate data and your benefit period analysis. They will ask for job costing or timesheets for fulfillment costs, formal policy memos for your practical expedient elections, and heavily documented impairment reviews proving that you actually checked the health of your contract portfolio at period end.
Finally, Section 5, Controls and Close Operations. Let's talk about your month-end checklist and escalation path.
So how do we make sure all of this actually happens without a hitch? We rely on a highly structured team and a rigorous period-end checklist. It all starts with the natural escalation path of teamwork. Step 1 is the team member, who identifies and records the transactions and flags anything unusual. Step 2 is the team lead, acting as the primary reviewer and escalating any of those heavy, judgment-based conclusions. Finally, Step 3 is the manager, who approves those complex judgments, thoroughly reviews the disclosures, and officially signs off. This structure is absolutely essential because it acts as a critical series of safety nets. Capitalizing contract costs requires a ton of estimates, like benefit periods, for example, and you definitely do not want those big decisions happening in a silo.
So the crucial point is how this team executes their month-end checklist. Phase 1 is identification and classification. This step ensures that all new costs are rigorously tested before capitalization even happens. The team has to confirm that every single new contract is reviewed, that the incremental test is actually applied, that fulfillment costs meet all 3 strict criteria, and that you've confirmed your practical expedient is being applied consistently. Doing this right stops bad data from ever entering your balance sheet in the first place.
Phase 2 is the ongoing maintenance of those assets, amortization and impairment. It is definitely not enough to just set up an amortization schedule and forget about it. Every single period, the team must confirm that amortization is recorded correctly, but more importantly, they need to review the entire portfolio for cancellation risk or customer credit stress. If a customer is facing financial trouble, the team needs to perform an impairment test immediately. And if a contract gets canceled, that asset has to be written off right then and there, no delays.
And finally, Phase 3 ties everything right back to the beginning of our explainer today, presentation and disclosure. Before the books are officially closed, the manager has to confirm that ASC 34040 assets are clearly and correctly separated from ASC 606 rights to revenue. They need to verify that the 12-month rule was perfectly applied to split current and non-current assets on the balance sheet. And lastly, they ensure that all policy notes and quantitative disclosures are fully updated, totally accurate, and ready for the public.
And honestly, this brilliantly illustrates what it takes to actually master ASC 34040. It is so much more than just a single journal entry. So, I'll leave you with this final thought to wrap up our course. Take a hard look at your own company's contract portfolio right now. Are your capitalized contract costs genuinely ready to be reported, disclosed, and defended against an auditor's strict scrutiny? Take this comprehensive framework, implement these exact checklists, and take total control of your close operations. Thank you so much for learning with me.